Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and/or financial topics. So we're going to dive right in, take a look, see what people are sharing. If you want to follow me at Finance, if you want to join our community, finding-value.com, where I dive deeper into all these topics, looking for potential investment opportunities. We're going to start with Wall Street Silver. Unrealized capital gains tax failed in Norway. And I know some people, I think some of the Democrats are talking about unrealized capital gains tax. What that means is that they're going to tax you if you're up on an investment uh, before you even sell it, is what I understand. I'm wondering if I could take unrealized capital losses too under this regime. It says interesting lesson on the impact of taxing unrealized capital gains. Norway expected an additional 150 million in annual tax revenue, but caused 54 billion in wealth to flee the country, costing them 600 million in annual tax revenue. If they do that here in America, I would have to seriously question living here any longer if they were to tax unrealized capital gains, because that is absolutely that is something I do not agree with at all. We've got this here, Seek Wiser. It says, according to society, luxury is cars, expensive clothes, a lavish lifestyle. The real luxuries in life are slow mornings, freedom to choose, a good night's sleep, a peace of mind, calm and boring days, being present, people you love, people who love you back. These are not things to be acquired, but rather the results of a purposeful and fulfilling existence. I agree with that. Um, I never really fell into this at all. Um, I'm actually I like cars. I like cars in terms of the driving experience. I am the exact opposite. I buy just the cheapest clothes. This is definitely not me, and I don't live a lavish lifestyle, but I do, and I am working towards this right here, which basically is me. It's not me because I read it here. It's just, I don't know, that's what I would basically have aspired to be, is just, I don't want a filled up day with a bunch of meetings that don't mean anything. So that leads to slower mornings and the freedom to choose whatever the heck you want to do. That is perfect. Geiger Capital says, "Holy crap! I thought this was fake. California is going to give $150,000 taxpayer-funded loans to illegal immigrants so they can buy houses, taking money from U.S. citizens and giving it to illegal immigrants so they can buy the limited supply of homes instead." Now, here's my question. If they're illegal and you don't have any paperwork, how does someone prove that they're an illegal immigrant? So if I went into California and I said I don't have any documents, just hypothetically, and I said I'm an illegal immigrant, do I get a loan or do they have to prove that I'm a citizen? Like, how does this even work? Because if I am a citizen and I don't provide any paperwork to them, how do they disprove that I am a citizen? They would have to somehow know my name and something. And if I don't share that with them, I don't know how this works. Like this is why does anyone still live there? Like this is absolutely ridiculous, guys. When I read this, I'm just like I don't understand at all. I don't. High Heat says 2008 oil at 147. This guy went on a European cruise. Oil started having huge drops, which I assumed were related to subprime. Looking back, it was early results from tight oil drilling. He says, I underestimated shale's potential. Investors today are making the same mistake in reverse, in his humble opinion. I made the same mistake back then too. I was a newer investor. In 2008, I was 27 years old, and I was listening to a lot of the peak oil guys. Back then, it was Matthew Simmons, Richard Heinberg. There's what's his name, Colin Campbell, I believe, was another one. I was listening to all of them, and they were basically stating that conventional oil was peaking, which they were right in. But I underestimated shale's potential. And right now, I think everyone right now is overestimating shale's potential to continue the party going. So I do agree with this, and I relate very much to this person's post here. Here's another one. The Economist. America's recession signals are flashing red. Don't believe them, says The Economist. It says, will this turn out to be the worst take since the 2007-2009 financial crisis? I don't know why they would even release something like this. It says America's recession signals are flashing red. Don't believe them. We assess a range of measures. Maybe they're talking about the SOM rule and the unemployment rate going up. Um, I hate to say it, but if you actually calculated everything to the T, so if you accounted for inflation properly, we are already in a recession. So I don't believe this at all. I think we're already in a recession. It's being hidden by money printing. So nominally, they're hiding it. They're understating inflation and overstating GDP. That's what I think is really going on. Down HFI research, it says the incoming structural natural gas demand increase in the coming years won't be met by the increase in natural gas production under rosy assumptions. So he thinks there's probably going to be a tightening of natural gas and probably a higher natural gas price. I agree with that. We got a lot of stuff coming online here for increased takeaway capacity, a lot of increase in natural gas demand around the world, lots of LNG terminals being put up, going into operation in the United States and in Canada. So this is going to be a real interesting time for natural gas, and where the natural gas prices are today, it's signaling do not produce. It's signaling hold on, hold on, wait a minute. Let's cool it all down in the production side. Charlie Bolello, he says global equity returns this year, and he's got a bunch of different countries here. Mexico being the worst, and Brazil. The worst are over here. This is where I think the opportunities are, Brazil and Mexico. The high ones, Argentina, Peru, Malaysia, US, Taiwan, Denmark. Those are the ones that are going up the most. I always go where things are hated the most because usually these, which are the worst, end up being the best over a couple years. And I think that will be the case. I think we're going to see Brazil and some of the, Mexico and stuff be a very strong performer from currency differences, what we'll say. Parker Ross says, great chart by Patrick Sainer, putting the annual growth and unemployment rate into perspective versus prior cycles. Here's another way to look at it. The unemployment rate was up 72 basis points year over year in July 24 versus 10 basis points at recession onsets since the 1950s. It has never been up this much year over year, aside from when the economy was already in a mild recession. And that's why I think we probably are already in a recession. So, will it continue? What will it look like going forward? I don't know those things. But I can say that unemployment has gone up dramatically over the past years. It says a chart that obviously causes some Fed discomfort. The U.S. unemployment rate and recessions. Here's the 2024. This is the percentage points difference from rate 1 year before a recession, and it's way up there. Coming on back, we've got Oliver Grab. The world's largest copper producer, Codelco, continues to have significant production problems. The Chilean mining giant's output recently fell to a new 20-year low. Wow, look at the falling quarterly production. We are down. The difference is minus 8.2%. Look at Codelco's production going down, 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 down. I don't think they can turn this around, guys. They were producing over here 475, 500, and we're all the way down here at 275. I mean, that's almost a 50% decline. Oh my God. Um, so it looks like copper is having some major issues growing production. And Codelco, which is the largest producer, well, that's not helping the mix here. This is pretty alarming, to be honest. After I look at this move here, because I mean, this isn't like a slight decline here, guys. This is going from 500 down to 275. That's almost a 50% decline. That's crazy. All right, historical pumps and dumps after rate cuts. So the data and charts below represent the price action of the S&P 500 after the Fed cuts in markets where unemployment is on an uptrend, which we just looked at above. It says the top right chart. The U.S. economic leading indicator is on a downtrend, bottom left chart, and the 10 and 2 is inverted, the bottom right chart. So the charts are here. You can see the index is going up for the S&P 500. We've got the United States Coincident Economic Activity Index declining. We've got the 10-year Treasury constant maturity minus the 2-year, which is coming up. This is inverted and uninverting. And then we've got the unemployment rate going up. When you combine all these things, we've always had pullbacks, pullback, 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 almost every time. Maybe not every time, but a lot of the times. So here is the data. If you were go back and look at the data. So when we had these all in alignment that he's showing, so July 20th, 1989, and again, this is after the Fed cuts in the market. We were up a little bit in the first 25 days, and then we went down 21% in 285 days after. July 13th, 1990, this was going into basically a housing real estate bubble. We were up a little bit for 2 days, and then 88 days after, we were down 20%. January 1st, 2001, another one that we had a recession. We were up 8% in 28 days, but we were down 40% in the next 2 years, year and a half, 2 years. September 18th, 2007, we were up a little bit in 23 days, but then we went down 54% in 538 days. And then March 3rd, 2020, they did that cut. We were up a little bit for 1 day, and then we were down 29% the next 20 days. So the average was up 4.5% for 25 days after the first cut. And then after that, we've been down 33% for 335 days after the first cut. The charts are on the monthly setting. The dates, okay, so we are mainly down after those rate cuts, about a year out. Closing the gap nicely, WTI now just $2 undervalued. So given where the stocks are at, commercial inventory levels, we are $2 undervalued. The implied WTI fair value of $79 is where it is currently. The goal of investment is to find situations where it is safe not to diversify, says Charlie Munger. Good quote. Market breadth doesn't look like this during a bear market. So the breadth that we're seeing across the board here, in his opinion, doesn't look like a bear market. So we're getting conflicting data. We're getting the ones above where whenever we get these rate cuts, we see these big declines a year after or so. But the market breadth is what makes us all confused because we're seeing breadth go up, we're seeing unemployment go up, and we're getting mixed signals. Hence, going all the way to the top here of what they had that article, America's recession signals are flashing red. Don't believe them. It's kind of a weird setup going on right now. Here's another quote. It says, money makes problems go away, but amplifies personality traits. Money won't change you, but it will amplify who you are, says Derek Sivers. I've experienced that myself. There are things where when you obtain more money, you may not be willing to do. If you don't have money, you're willing to do a lot of different things, maybe at work, maybe the work that you do. You're like, well, I'll do that. I'll do anything. I'll do anything to move up, is what some people will say. But when you get a lot of money, you're like, I don't want to do that. I don't really care about doing that. And all of a sudden, you're like, I don't really know if this job's a good fit. It's it's um it's weird when you get enough money where you start to make different decisions, and it will change you and amplify who you are. I totally agree with that. Grady says major fiat currencies are in a losing parabolic run versus gold. The standard foreign currency exchange pair charts does not reveal the debasing of fiat currencies. You need to measure it versus gold. And vital to realize this is not gold going up, it is mainly fiat currencies going down. This is XAU AUD, XAU Canadian, Great British Pound, and the Euro, and these things are just going vertical here, with gold just ripping. Interesting. A new inflationary impulse is building, according to Global Macro, which goes against the recession people. This is global shipping rates year over year percent. The global container shipping rates are rocketing higher. We're at a very high level. What's going on here? How can we be in a recession and shipping rates are ripping to the upside? How is that possible? I don't know. I mean, you could call it a restocking fee, but that a restocking, time, it doesn't correlate very well with the recession. So just like silver platinum is now sitting right below a historical, huge blue breakout line. A generational breakout and opportunity is incoming also for platinum. It has now been basing out for about 10 years, just like back before the start of the secular bull market back in the 1990s and in 2020. It resumed its secular bull market after 13-year-long cyclical bear market. The coming blue breakout will confirm resumption of the secular bull market. Also, the blue breakout will mark the start of wave 3, which is the strongest and most profitable bull market phase. You guys ready for this? This is platinum ready to break out. This is the first leg, and here comes the second bull leg of this. He is estimating a generational breakout opportunity. I agree with that. I'm loaded to the gills. I love platinum. I think it is a very good opportunity for a long-term investment, and we'll probably see this go all the way to $5, $6, $7,000. It may even go more than that. I mean, if gold goes to 10,000 or 9,000 at the end of the bull market, there's a possibility that platinum's 2 times the price of gold by the end of it. That's what we've seen in history before when platinum gets expensive. And that's what we've got for today, guys. So we'll end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. And we'll catch you guys later. This is Finding Value.